Hey everybody, back with another special video, and today we're going to be looking at portfolios. Specifically, I've been hearing a lot of questions and concerns regarding fear and volatility in the market, so I thought I'd do a video on how to build a defensive income portfolio for this particular kind of market. We're going to go over the components of the portfolio, what they're supposed to do, how we hope they'll perform, as well as some caveats to what could occur and some issues that it might face. So first we have our portfolio here, and we'll start with our largest allocation. We're going to start with NUSI, which is the Nationwide Risk Managed Income ETF, which is named exactly what we're hoping to do. This particular fund runs an options collar strategy. Essentially, you're going to get your covered call options income that you would get from other things like QYLD, XYLD, RYLD, or other such funds, but it's going to use some of those premiums that instead of paying you, it will use to buy put options to cap the downside risk. This is going to be the biggest part of our portfolio at 40%, almost half of our portfolio, specifically because I've gone over the documents for it, and I think that the strategy that it presents is one of the better downside risk management strategies that there are. There are other funds that have downside risk management, things like JEPI, as well as some long-term put strategies on the market in general, but I like this one the best because it simplifies things down, and over the last 2 years, well, since its inception, it did prove itself pretty good during the last drawdown. So that's going to be our largest position at 40%, but it doesn't necessarily have to be that number or this fund. This is just a baseline. Our second largest position is going to be our first bond position, in this case SCHZ, which is an aggregate bond ETF, just the one I picked. There are a lot of aggregate bond ETFs. I just like this one in particular because I've read about it the most. This is going to average out to intermediate bonds, relatively low yield at only about 2%, but this is just a market hedge. We're going to be throwing 15% in here. After that, we're going to go to short-term bonds at 10%. Again, just a placeholder ETF with ISTB. This is going to be short-term bonds of government, corporate investment grade, and corporate high yield, as well as asset-backed securities. So our total bond ETF position is going to be 25%. I just chose 15 and 10 because I like those numbers there. You might switch it around a bit, but this is going to make up the second part of our hedging. As we can see, we've got 65% of our portfolio is essentially a hedge, one for equities, the rest with bonds. So the not the vast, but the majority of our portfolio, the super majority of our portfolio is going to be a hedge. Now, just because these are hedges doesn't mean they don't have problems. We will go over those after we go through the rest of our portfolio. Our last ETF position is going to be SCHD. Again, a placeholder. My particular favorite when it comes to income, or I should say dividend appreciation ETFs, but there are a lot of other ones. The reason we're going to throw this in here is because we do want to have some market exposure to growth. Just in case there isn't a huge crash, we do still want to be able to get some growth out of our portfolio to make sure we don't just stagnate at a certain amount of money if we don't have more money to put in. After that, I've allocated an additional 25% to equities. In this case, I chose 5 companies and equally weighted them at 5% each. First, we have Verizon, large cap telecommunications with a good yield over 4%. They're not going to go out of business unless something crazy happens. Same thing here with IBM, large cap tech, blue chip stock, not going to go out of business unless something crazy happens. We go down to Altria, again, very large company. Tobacco isn't going out of style anytime soon, no matter what you might be hearing. Also pays a very nice dividend, so they're also going to be in our portfolio. We have 2 small caps here. I'm not suggesting you use small caps. I've just researched these companies and I like where they sit. Our energy allocation is going to be through Not Offshore Partners. It's not an LP, even though it says it is. It is a C corporation. Very high yield of about 11% right now, and suffered the drawdown from the last market crash very well, maintained their very nice dividend, and did very well. I don't like it. If I'm picking a single stock for exposure to the energy market, I prefer Energy Transfer myself. A lot of people don't. That's okay, but I would try to stay away from the big 3 like the Exxon, Chevron, and Shell, because they are going to take the brunt of that down market if it affects energy pretty hard because they do extract and sell the product. Our last position is going to be our consumer discretionary. For me, it's Spartan Nash Company, nice 4% yield. Small cap company, very low margins, but they have government contracts, so they have essentially almost guaranteed money. This might be something else for you. This is just the one that I chose. So let's first talk about some of the issues that the fund may face. There is the obvious issue of if there isn't a downturn in any way, you're going to perform worse than if you just were in the S&P 500 or the NASDAQ. That's a given. But if we're looking for income, we shouldn't really care about that. That's not what we're looking for. We're not going for hardcore growth. We want to get income with a little bit of growth. So with that aside, what are some of the other issues? Our bond positions are some of our largest issue here. If there is a market downturn and interest rates rise, we could see our bonds perform even worse than our equities. We could see, say, our equities might drop 20, 30, 40%, but if the market fails, so to speak, and interest rates continue increasing, we could see our bonds be cut in half or maybe worse if things go really poorly, because as interest rates go up, bond yields increase, which drives bond prices down. This is part of the reason why we do have 10% allocated to short-term bonds. If you're really scared of rising interest rates, you could up this to the entire 25%, and I really wouldn't see an issue with that. Some other issues we might face is if this is a protracted decline, something like NUSI is really meant for large market downturns, that is the market crashing 20, 30% in the space of a month or so, like we saw in 2020 where NUSI performed very well. We haven't seen it over a long-term downtrend, either an L-shaped market or just a very, very slow, slight gradient on the line going down over a long period of time for the markets. It's hard to say there, but I do like the strategy better than others, so that's why I like this one. Again, look at a bunch of different funds, see which one has a strategy that you like, go with that. When it comes to our equity positions, they're just going to be the simple equity risk that you always have, as if the market goes down, you're probably going to go down with it. That's why we have, in this case, SCHD, a lot of large cap, very stable companies. You should still be getting your dividend from these positions, even if the market has a downturn, because these aren't likely to go out of business without something really bad happening. Now let's look at how our portfolio did between January 2020, right before the downturn, into the current day. And as we can see here, if we started with 10,000 at the very end of 2019, our worst drawdown was in March of 2020, and we lost a total of 8.5%. Not bad at all, considering the broad market was down, depending on the index you're looking at, about 30-ish%, 25%, depending on how you really measure it. Only being down 8%, if maintaining your capital is important to you, this strategy would have worked very well for you. You would have been able to, if you were one of those people who wants to pull their money out during a market downturn, you would have been able to pull your money out without a huge issue if you needed it for something. Say you were unemployed, say something happened, you needed that money on hand, you wouldn't have seen a ton of it disappear. If we see it go out to today, we can see that it has done about 20% over that period. Not bad at all compared to standard market returns. However, let's go put it up against the bond market and against the equity market to see how it did. So in that same amount of time, we have two different funds we're going to look at here. The SPY, probably the most known ETF in the world, tracking the S&P 500, is going to be our control for the broad market in stocks, and BND, which is the Vanguard Total Bond Market, is going to be our control for the bond market. And let's see how they did. As we can see, the drawdown here for the S&P 500 was about 20% for this fund, more than twice, 2.5 times to be exact, the amount for our defensive fund, while the bond market, of course, went up a little bit because bond prices had their day. As we can see, as we get to today, we can see that the total returns for each portfolio is starkly different than our portfolio. The bond portfolio only returned about 5% over that time, while the S&P 500 returned about 36% over that time. But again, since we were looking for income, we really shouldn't be too concerned about underperforming the market by that much because our issue wasn't trying to get that much in returns via the market. It was to preserve our capital while getting income. So what's our takeaway here is, if you're scared of the market, is this something you should look at? I really designed this portfolio for people who are seeing a little bit of fear in the market. But they're looking for income. This is going to be for people probably between the ages of 20 and 40. If you're older, or close to retirement or retired, these allocations are going to be much different because you have much more capital you need to preserve if, say, you're retired and you don't have another source of income. So just be aware of that. This isn't going to fit everyone. This is just, I think, for someone like me who's looking for a good bit of income, a little bit of equity participation to try and get a little bit of appreciation, but not too much, while being able to maintain their capital. I hope this helped, and thanks for watching.